Hey everyone, welcome back to Canada Accounting Insights, the channel where we take complex accounting standards and make them clear, simple, and practical. If you're new here, don't forget to subscribe and hit that like button so more students, accountants, and business owners can find these helpful videos. Today we're diving into revenue recognition under ASPE Section 3400. This is one of the most important topics in accounting, and I'll walk you through it step by step with examples so it really sticks. Let's get started. First, let's answer the big question. What is revenue under ASPE? Revenue is the inflow of cash, receivables, or other consideration that a company earns from its normal day-to-day operations, like selling products or providing services. But here's the key. Under ASPE, we can't just recognize revenue the moment a sale happens. We need to check that three specific conditions are met, and that's exactly where we're heading next. To recognize revenue under ASPE, three things must all line up. 1. Performance is achieved. 2. Revenue can be reliably measured. And 3. Collection is reasonably assured. Now let's slow down and unpack each of these, because they're the foundation of revenue recognition. So, what does it mean for performance to be achieved? ASPE gives us a checklist of indicators. Evidence of an arrangement. There has to be proof of a deal, like a contract, invoice, or purchase order. Delivery or service completion. Goods have been shipped or services are performed. Risks and rewards transferred. The buyer now carries the risks, like damage or loss. No significant continuing involvement. The seller has given up control. Only when these are met do we say, yes, performance has been achieved. And that brings us naturally to the second condition, measurement. All right, so the deal is in place and performance has been achieved. Next, we ask, can we reliably measure the revenue? If there are discounts, rebates, or variable fees, those all need to be considered. We can't record revenue until we're confident about the amount. Think of it like this. If you sell goods with a 10% rebate at year-end, you don't record the full invoice as revenue. You reduce it by the rebate. Once the amount is measurable, we then move on to the last condition, collection. Now, just because you made a sale doesn't mean you'll collect the cash. ASPE says revenue is only recognized when collection is reasonably assured. If there's significant doubt about the customer's ability to pay, revenue is limited to the amount you expect to collect. For example, if you sell to a customer with a shaky financial record, you might hold back recognition until payment is more certain. So, with these three conditions, performance, measurement, and collectability, the basics are in place. But revenue recognition isn't always that simple. Sometimes, delivery terms and pricing can complicate things. Let's look at those next. Delivery is a huge part of performance, but timing can vary depending on the situation. Shipping terms. If it's FOB shipping point, risks transfer when the goods leave your warehouse. If it's FOB destination, risks transfer only when the goods arrive at the buyer's place. Installation requirements. If the goods need significant installation, you wait until installation is done. Bill and hold arrangements. If a buyer asks you to hold the goods, revenue isn't recognized until they've really assumed ownership risks. For example, if you sell machinery in December but install it in January, you can't recognize the revenue until January. Now, delivery is one piece of the puzzle. The next question is, what about the selling price? Sometimes the price of a transaction isn't as straightforward as it seems. Here are the common issues. Right of return. If customers can return goods, you wait until returns can be reliably estimated. Discounts and rebates. These reduce revenue and must be accounted for. Variable pricing. For example, sales-based royalties are recognized only when the amount becomes determinable. Collectability concerns. If there's doubt, you only recognize what you expect to collect. So as you can see, both delivery and pricing can delay recognition. Once those are clear, we can move to how ASPE classifies revenue types. Let's transition into that now. ASPE breaks revenue into three main categories, and each has its own recognition rules. 1. Sale of goods. Revenue is recognized when goods are delivered, risks transfer, and there's no continuing involvement. 2. Rendering of services. If you can measure progress, you use the percentage of completion method. If not, you wait until the job is done and use the completed contract method. 3. Use by others of company resources. This covers interest, royalties, and dividends. Interest, recognized over time, using the time proportion method. Royalties, recognized on an accrual basis, following the contract. Dividends, recognized when the right to receive them is established. For example, if you license software and earn royalties, revenue is recognized as sales happen, not upfront. Now that we've covered the types of revenue, let's see how they're presented and disclosed in the financial statements. ASPE requires companies to present revenue clearly, separating major categories like product sales, service revenue, and investment income. And in the notes, companies must disclose their revenue recognition policies, the method used for long-term contracts, and any significant judgments involved. Okay, we've looked at ASPE on its own, but how does it compare with IFRS? Let's explore that briefly. Under ASPE, revenue recognition is more rules-based. Goods, services, and other revenues each have their own guidance. Under IFRS 15, there's one unified 5-step model based on the transfer of control. It's broader, and sometimes recognition happens earlier or later compared to ASPE. So, if you're moving from ASPE to IFRS, be prepared for a shift in thinking. And before we wrap up, let's quickly highlight the pitfalls to avoid. Here are the mistakes accountants often make. Recognizing revenue too early, before delivery is complete. Forgetting to adjust for returns, discounts, or rebates. Mixing up service methods, using percentage of completion when it's not reliable. Ignoring collectibility concerns. By keeping the criteria in mind, you can avoid these traps. So let's bring it all together. Revenue under ASPE Section 3400 is recognized only when performance is achieved, revenue is measurable, and collection is reasonably assured. You then apply these principles across different revenue types, goods, services, and the use of resources like interest, royalties, and dividends. Always watch out for tricky details like shipping terms, installation, returns, and discounts, because they can shift the timing and amount of revenue. If you found this video helpful, give it a thumbs up and subscribe to Canada Accounting Insights for more clear, beginner-friendly breakdowns of accounting standards. Thanks for watching, and I'll see you in the next video.